Hello. Good morning.
Hey, who am I talking to?
This is Tosin.
Hey, how you doing?
I'm good. How are you?
Good, good. Hold on, let me get my... Can you see me?
Oh yes, I can see you. I'm trying to
Awesome.
get. Oh my.
We'll start here in about 5 minutes.
Okay, 5 minutes. Okay.
Yeah, so I try to start right at 10, and then like I talked about last week, a couple of the students wanted to go back and look at some stuff in chapter 6 on closing entries. So I decided to do a quick review on how to do closing entries, because I think this might also help you with the project. And then I'll go back in and depending on the time, look at some more adjusting entries from chapter 12. So it looks like Everett just logged in. So I'm thinking I think we had like 3 or 4 in the class last week. So I'm guessing we'll have about the same. So about 3 or 4 more minutes and then we'll get started.
Okay. Yeah, last week I was on. I don't know what happened to my laptop. My laptop was acting weird. So.
Yeah, were you able to log in last week, or did you try, or did you have a computer issue?
I had a computer issue.
Okay, no problem. Were you able to go in and see the meeting in Blackboard? Because I recorded everything.
Oh yeah, yeah, I saw it last night. So
Awesome.
I'm gonna go back and watch it.
Great. Everett, can you hear me?
Yes, I can.
Awesome. All right. All right, I've got 10 o'clock and it looks like we've got 2 of us in here today. That's fine. Just remember that, you know, if you have to leave at any time, that's no problem. Whatever we do in here, I'm recording. And then after we're done, I go ahead and I post this into Blackboard so that you can go back and review it as well. So I think that's a benefit. So, all right. So like we talked last week, I'm gonna go back for a minute and just review a concept on closing entries. So I shared my screen. You guys should see exercise 6.1 where it says journalized closing entries. If you can't see it, let me know it. I'm going to walk you through this, a little bit of review on this. So before I do that, let me do one thing. And I just want to remind you this, a couple things. I went ahead and pulled up a little whiteboard. So just a couple things on closing entries. So remember, I always say there's, let me see how I get this thing to work here. There's 2 objectives to closing entries. One objective is we want to close out what we call the temporary accounts. And of course, you know, if we had been in class and we had actually been on campus, we would have done this thoroughly, but hopefully my videos are okay. But just to remind you, a temporary account is any account that is on the income statement. And so if you remember what's on the income statement, which are revenues and expenses, that's really it. That's an easy way to remember a temporary account. So any revenue account, which I think we've been using fees income, or if you get to some of the later chapters, they use an account called sales revenue. And then of course, anything that says expense, that's what they call a temporary account. And so to remember the temporary accounts, you just remember what's on the income statement plus the drawing account. That's the one that stands out. So you've got revenues, expenses, and drawing. So that's one of the objectives to closing. And when I say close out, that means zero out. That means if you go to a T account in your ledger, just for example, let's say we had, let me change this. Let's say we had $100,000 sitting in revenue. And what the closing entry is going to do is it's going to go into that ledger account and it's going to take that $100,000, and the goal is we want that to be zero. Now, the next question should then be, well, if we're going to make this zero, the question is where are we going to put this? And that would be the second objective, is we are simply going to be updating the capital account. So everything goes to capital. So we're going to take all the revenue, we're going to put it into capital. So if I, like, let's say if I draw a T account again, here's our capital account. So we're going to take all the revenue and we're going to basically transfer it to capital. The same thing with expenses. All of our expenses, we're going to be zeroing them out and then transferring them into the capital account. And then the same thing with drawing. The idea is you're kind of cleaning up the ledger. Most companies, most organizations look at their financial statements monthly. And so what they do is they do an accounting close. And so every month, they'll zero out the temporary accounts and they'll transfer everything into capital to get a sense of the financial statements to see how the company is performing. And then just because we close these out, what then happens is it's kind of like, if this makes any sense, it's like we're resetting the accounts. We're going to use the same accounts again. It's just that each month we're going to start over at zero. And then each month we'll accumulate revenues and expenses and drawing, and then we'll transfer them in to capital, just like you do, you know, essentially, you know, every month. So let me go back. Let me clear this. So one more illustration, and then we'll get to the problem. So just to kind of recap, you know, so if I just, again, here's my visual. So we all know now what a journal is. This is where you record. And then of course, we know that we post to the ledger, which we're essentially, I'm using the T account idea. So when we post all of our entries into our ledger, we update the ledger. And then of course, the last step is then to get to your financial statements. Again, I'm just keeping it as simple as I can keep it. And so the concept of closing entries, we're still entering journal entries. It's just that we're going into the ledger and we're looking for the temporary accounts. So this requires the knowledge. This requires that you understand what the temporary accounts are, which are revenues, expenses, and drawing. We're going to zero those accounts out. And then the idea here is the capital account we're going to be updating. Okay, that's what we're doing. We're transferring everything to capital. And then once we've done that, then essentially your financial statements are set, because just remember, we do what? The income statement is the first one, and then we do the equity statement, which is the second. And then of course, the third one, we do the balance sheet. So just to kind of remind you, this whole process of closing, essentially what we're doing is we are calculating what the equity number should be, and at the same time we're figuring out what the balance should be on the balance sheet. So think of, you guys have actually already done kind of like a version of this. Whenever you do the equity statement, you figure out what the ending capital is. Think of the closing entries as simply just the process of how you make that happen. Okay. All right. So having said that, I'm going to go back. All right. So here's problem 6.1. And in problem 6.1, they tell you, notice it says journalize the closing entries. And of course, this is for December 31st, 2019. At the bottom, and I think I mentioned this, but just to remind, it says all accounts have normal balances. That means, back to our debit and credit rules, that means the increase side. And then they want you to simply journalize the closing entries. So before we would want to do that, let's just take a quick look at this. They're giving us all the accounts. These are all the accounts in the general ledger. And on closing entries, remember, we just want to close out the temporary accounts. So down below, the question is which one would be considered temporary? And so, if we had a class discussion on this, I would simply go back and forth, and there'd be some more exercises and you can review those. But I go back and forth. I say, first of all, ask yourself this: is it on the balance sheet? If it's on the balance sheet, remember, balance sheet is your assets equals your liabilities plus equity. If it's on the balance sheet, it's a permanent account. So for example, if I looked at cash and I'd go through the class, I'd say, guys, is cash a permanent account or is it a temporary account? And of course, you'd say, well, cash is on the balance sheet, so therefore it's got to be a permanent account. We would not want to close this account out. We're not going to even use that one. Okay, so I go to the next one, accounts receivable. Of course, ask yourself, is that permanent or temporary? You say, well, where's accounts receivable? Accounts receivable is on the balance sheet. It's an asset. So that's, hopefully an easy way to, to remember how to recognize if something's temporary or permanent. And of course, to remind you again, remember the temporary accounts is any account that's on the income statement, which is your revenues and expenses, plus the drawing. So the way they set this problem up is if I'm just going from top to the bottom here, supplies is an asset, so that's permanent. We're not gonna close that one out. Equipment, that's an asset. That's on the balance sheet. We don't need that one. Accumulated depreciation. This one confuses some people. This is always a trick because we do have that one account that's called depreciation expense. But this account, whenever you see the words accumulated depreciation, remember that, of course, is a contra asset. So of course, that's also on the balance sheet. So we're not going to use that. Accounts payable, that's a liability. We don't need that. And then of course, we get to capital. Now, capital is not a temporary account. It's a permanent account. And we're not going to be closing it out, but it's the only permanent account that we use in the closing process because we are simply going to be updating it, not closing it out, but updating it. Okay. Now, everything else, here we got the drawing, fees, income, and then these are all of your expenses right there. I'm just going to summarize this. All those are temporary accounts. Okay. Now, because we had to go to this online setting and online format, generally when we'd be in a classroom setting, I would show you an alternate way on how to do the closing. But because we're not, and I don't want to confuse anybody, I'm just going to follow the textbook approach on how they're going to go through this closing process. And they do it in 4 entries, okay? I typically would do it in 3 entries to keep it a little more simple. They like to add this account called income summary, which is okay. You don't have to do it. But, you know, because they did it and it's in the textbook, and it's also on my illustrations on my PowerPoints in Blackboard, that's the way I'm going to show you right now. And then at the end, I'll go back and I'll show you just the alternate way. It won't confuse you, but it's an alternate way that might actually make more sense to you. So what I'll do now, here's how I would typically do it in class. I'd say, okay, if we're going to do the closing entries, our first entry is number 1, we're going to close out the revenue account. In this case, we only use 1 revenue account, which keeps it nice and easy. And in this case, that would be fees income. So just to illustrate here, if you would go to fees income in our ledger and it has a normal balance, that means it would have a credit balance of 107,500. And so if we want to make this account go to 0, we would have to debit it by the same amount. So the way we would do this is we would debit. I'm going to write it out first, and then I'm going to kind of go back and forth between the journal page, the answer sheet, and each entry. But let me just, since I got this up, I'm going to write it out first, and then we'll go to the actual entry, so in case you can't read my writing. But what we would do is we would debit fees income for 107.5, and then I'm going to follow the textbook approach on this one. We would credit a new account called income summary for the same amount. Now keep in mind, income summary, all this is used for, it's a temporary account that's just going to be used in the closing process. It does not show up on a financial statement. We're just using it to close out entries. So in fact, it's going to get closed out as well. So if that's our first entry, and then we'd post to our ledger, fees income would get a debit posting of 107.5, and then of course it would then have a 0 balance. But then the next question would be, I'm going to write this off to the side over here. Income summary would now have a credit balance of 107,500, and I'll make a note that would represent the revenues. So having said that, let me just kind of go back. I'm going to go and show you. I'm just pulling this right from, this is your solutions. So this is what if you go into Blackboard, you guys actually have this. I just want you to take a look at the first entry here. Notice they debited fees income for the 107.5, and then here's income summary getting credited, and then of course there's the credit. And again, for this one right here, I just want you to look at the first entry only. Don't look at anything else. I just want you to focus on this entry right here. And I would generally call that closing entry number 1. And we're done. That's it. Now, the second entry, let me clear this. Go back. All right. So then the second entry, then what we're going to be doing is we're going to close out the expenses. So second one I would say now is we're going to look for all of our expenses, and we're going to close our expense accounts. So all of our expenses are pretty nice and easy on this one. Just look for something that ends in the word expense, and they're all grouped up right there. We've got depreciation, salaries, supplies, telephone, and utilities. Okay, that's our expenses. So just to illustrate, I'll just do one of these because I can't write it all out. It's going to take up all the slide. But let's say I'm just going to write out depreciation expense. And remember, the key here, normal balances. That means that depreciation would have a debit balance in your ledger. If we're looking at your ledger, depreciation expense would have a debit balance. And if we wanted to make this account go to 0, we would actually have to credit it. And of course, that's going to be consistent with all the expenses. All the expenses have debit balances. And to make these go to zero, we're going to have to be crediting the expenses. And so what we'll be doing then is income summary, all right, is going to get the debit, and all these expenses will be credited. So we would have depreciation expense. We're going to be crediting that for $5,500. We would have salaries expense. We would have to credit that for $34,000. Supplies, $6,000. And hopefully you kind of get the point. You're just entering it. If this was at a company, at a business, you would go to the ledger, figure the balance, and then just take that amount and just manually, or most likely you have to manually do this one, or just link it if you're depending on the software that you're using. But take the balance and just make sure that all the expenses get credited. You have to do these individually. So as I'm showing you this, notice I'm just doing this in one entry. We've got telephone expense, and then of course we've got utilities. So this would be called a compound entry because we're using more than two accounts. So what you'd have to do is, if you added all these up, I believe that's 60,000. So all these expenses, if you added up all the expenses, that's a total of $60,000. So this would be what the second closing entry would then look like. So having said that, let me now go. And now I just want you to look at the second entry. And hopefully this makes sense now. Do you see how here's income summary, there's the debit, there's the 60,000, and then notice you've got depreciation expense, you've got salaries, you've got supplies, telephone, utilities, and of course, notice, you know, this is just one entry right here. That's one entry, that's one compound entry. So we've got the first one, which we closed out the revenues. This is the second one that we're now closing out all the expenses. Now, if I went over here, I'm just going to leave this one up. So let's write out income summary. And so let's look at what would be an income summary after the first two entries. You would have a credit of 107.5, and you'd have a debit of 60,000. Remember, that would represent your expenses, the 60,000, and the 107.5 would represent your revenues. So if we stopped right there, we'd say, okay, can you calculate a balance for income summary? You'd say the balance is 47,500, which is simply your revenues minus your expenses. So what that then does is notice the third entry. I'm just going to leave this one up. The third entry now is now we want to close out the income summary account, which if it has a credit balance, we need to debit it. So if we debit it for 47.5, that would then give us a zero balance. And since I got the solution pulled up, look at what you do. You debit income summary for the 47.5, and then here's where you use the capital. Capital gets credited for the 47.5. And at that point, that would be your third entry, and then you just got one more to go. Okay, so I'm just going to draw this up right here. Capital, of course, going into your ledger. Remember, our idea here is we are going to be updating the capital account. Now, if you went back to the previous screen, I'm just going to leave this one up. The capital balance in this problem had a beginning balance of I think it was 121,500. You go back and look, and I'll go back in a second, but it was 121,500. That was the beginning balance. If we now post all of these closing entries, after this third one, we're going to be putting another, looks like it's another 47.5 credit back into capital. All right. Now, once we've done that, Then the last one is simply to close out the drawing account. And again, go back to the previous page on the problem. Drawing had 52,000, and the way you close out drawing is you debit capital for that 52,000, and then of course you just credit the drawing account for the 52,000. Okay, that's the fourth entry. So once you've done that, I'll just label that number 4. That's, closing out the drawing account. Notice that capital gets another debit balance of 52,000. That's or debit posting. And at that point, you could then update the balance of capital because now you've closed out all your temporary accounts, and you'll get right at, my stylus isn't working very well today. It's right at $117,000. That would be your updated balance. Okay. So in a nutshell, I just chose this first exercise. This is, this is exercise 6.1, and you have this solution in Blackboard. I just chose this because it was nice and simple. Everything was right on one page, and it was easy for me to illustrate it for you. But this is all you do. You got 4 entries. That's how the textbook does it. 4 entries, close out revenues, close out expenses. Then we're essentially initially closing the revenues and expenses to the income summary. And then we close out income summary to capital. And then we close out drawing directly to capital. So if I go back now to the previous page, to the textbook problem, now that I've got this up, and of course, there's the drawing right there. Here's the fees income. And then of course, we've got all your expenses listed right over here. Okay. And then of course, actually, yeah. And here was that cap. I said the capital had a balance of 121.5. That was the balance that had already carried over from, a previous period, previous month, or a previous cycle. Okay. So having said that, that's essentially how I also set up your project. Whenever you get to your project and you're doing your closing entries, I set up your project in terms of your journal entries to look something like this. In fact, if you go and look at that template that I've given you on the answer sheet, you've got a setup very similar. I give you close out revenues, then I say close out expenses, and then I say close out income summary, and of course I say close out the drawing. So this is very similar to what you'll have to do on the project, but I think it's also relevant because, we've got, we're into chapter 12 right now, which if you go back and review chapter 12, they like to do a couple problems where they do both adjusting and closing, and then they do the closing entries. So they reinforce that in chapter 12 as well. But, since I didn't have you guys in class on this one, I thought it might be helpful to go back and just do a problem to show you how, it's nice to see something, live on how to do closing entries. It's not difficult. It's pretty much a set thing. Most businesses do a closing process every single month. And you have to have access to the ledger. And it's kind of interesting to know, and right now in today's time with, everybody's working at home, if you can still work, how you pretty much have to have access to some pretty sensitive information. So, the other thing that, if we had more time to talk, I'd bring up is just the security issues that, there's a lot of sensitive information that, a lot of accounting departments are now working at home. I know this because, my wife, she's a CPA auditor with the DCA. She audits the Boeing company. And we're pretty sure everybody at Boeing is home too. So I'm kind of curious on how they're able to do a lot of their work. I'm sure they've got, some software, some stuff set up, but, they're doing a lot of their work from home. To me, it's kind of interesting to see how, if something gets lost, or it's a lot easier for hackers and for people who are trying to steal information to now have access to it, because, everything's online now. And so anyway, but yeah, so you've got these 4 closing entries. I want to go back and review this. And I hope this also, not only just for the project, but also help you just in your understanding of what it is and why you do it. Okay. All right. So having said that, let me go back. All right. So what I'm going to do next is go back into chapter 12 for a second. So remember, we're actually into the adjusting entries now. And I did several of these last week with you, and I'm pulling up 12.1a right now, 12.1a. And what I'm going to do on this one, I'm looking at our time. We've got about 25 minutes. I'm going to do select adjusting entries from this particular problem. This problem does just about all of them that you'll have to do on the exam or the quiz as well. And so again, 12.1a, I've got this up. And you know, if something's not making sense to you and you want me to go back and just chime in or send me a chat or something as I'm talking, I'll go back and do it. But I just want to remind you, I told you this last week, I'm not going to have you be doing adjusting entries on merchandise inventory. They do a really strange way in this textbook. I've never seen it. I've seen it done this way before in textbooks, but I've never seen it done in the real world. But I don't believe that this is how most people would close out, you know, do adjustments to inventory. And for me to really go into all the details would take me probably, you know, 20 minutes, and I'm not going to do that. Just so you know, there's other ways to update inventory. So I'm not going to be doing A and B on this problem. On this one, however, I'm going to start on letter C, and I'm going to work myself down on this problem. Let's see how far I get with it. But the last part of it will be doing another interest problem. It's on letter K. So just to kind of get started here. So I'm going to start, for some recap, on letter C. And this is unearned seminar fee. So this is unearned revenue. So it says they have a balance of $6,800. It represents prepayment by customers for 5 seminars to be conducted in June, July, August 2019. 2 seminars had been conducted by June 30th. So what would have happened is we got paid money. So this is us. So they paid us $6,800, and we credited this account called Unearned Seminar Fees for $6,800. Now remember, this account is what we call a liability. It's a strange one because you don't see that word payable. The reason this is a liability is because we now have an obligation, and that obligation is to conduct the seminar. We got paid in advance. Sometimes that happens. Sometimes, you know, you walk into a lawyer and you need some legal advice, you need some legal help. Lawyers will say, yeah, I'll hear your problem, but if you want me to do any work, I require a prepayment of $2,000 or whatever. It's the same type of idea. So lots of times you get paid money in advance. So the way accounting treats this is if we get an advance payment, this actually contributes or, you know, indicates that we now have a liability that we now have to earn. So the adjusting entry will be to, once we've performed, we now can say we've earned it. That's going to be revenue. So in this problem, it says 2 seminars have been conducted. So you might want to take, just to do the calculation. So if you take 6,800 and you'd say, if you divide that by 5, that's essentially how much you're earning for each, that's essentially your fee for each seminar. And so if we take that 6,800 divided by 5, that's how much we make per seminar. And then it says that we've earned 2 of these, then you'd simply just multiply that by 2. And if you do that, I came up with 2720. That is what I'm going to write this out. That's what you have earned. So our adjusting entry, of course, guess it, we're going to be debiting the unearned account for 2720 and then crediting some sort of revenue account for 2720. Again, I'm going to pull up the official answer. So just, I'm writing this out just quickly so you can see it. I'll show you what the official names they use, and I don't want you to get too nervous about the account names, but if you look at, this will just be for letter C. Let me enlarge this. Notice they debited unearned seminar fees, and for some reason this amounts, it's probably because I enlarged it. Let me go back. You can't see the amounts here. There you go. All right. You can see the 2720. And then notice they credited seminar fees income for 2720. So that first one right here, this would be your, I just call it your unearned revenue. I keep it more simple than they do. I mean, they use the word fees income, and I don't know why they just didn't say seminar revenue. I don't know. It's all preference, and I prefer the word revenue, so I don't want that to throw you off. But anyway, this would be the first one I'm showing you. This is how you do an unearned revenue. And I know I showed you a couple last week as well. So again, this is a new one that we didn't do in chapter 5. This is a new one from chapter 12. Okay. All right. So that is letter C. Now, you'll notice that several of these are review. You've done these before. So hint, now let's take a look at, this is your prepaid. This is letter D, prepaid insurance. Prepaid insurance says they have a balance of 16.8. It's for 6 months. It was paid in advance on, there's the key here, on May 1st. So if I go back up, let me clear that. And I always try to maybe to start the problem, look at the dates. This problem is focusing on June 30th. That's our cutoff date. That's essentially our financial statement date. Because they say they have a fiscal year end on June 30th. So why that's important on this one, on letter D, it's that they tell you when the insurance was paid in advance, which was, of course, May 1st. So you have to think about this. So if this was on May 1st, it's what, $16,800. So what would have happened is we would have paid it up front. So just going to give you a note. We have $16,008 that we would have paid cash. And then, of course, we got to figure out what is our time period here. And our time period for adjustment will be May 1st through June 30th. And of course, we all know that is 2 months, right? So we have 2 months of adjustment here. So you could take that 16,800. You're going to divide that by 6 because we paid 6 months in advance, and then simply multiply that by 2. That should give us right around $5,600 of expense. So, and then of course you just do the adjusting entry. And so let me go back and show you that. And so that would be right here. There's your insurance expense debit. There's your $5,600. And then of course they're going to be crediting prepaid insurance. And then there's the credit of $5,600. Okay. Is that coming back? Does that make sense to everyone? I know I've been talking for a few minutes, but does anybody have any issues so far? Is it helpful? Are you following?
Yeah.
Yes. Following.
And you know, some of this may seem repetitive, but I think it's good to do some repetition because, you know, once you jump in, if you haven't done the project yet, or when you start to, you know, work on the project, it'll seem familiar to you, and you'll have more confidence as you start to do your calculations. Okay, so now let's take a look at letter E. And that one's going to be a depreciation problem. So again, I'm on letter E. Circle that. All right. So they say that store equipment costed $11,380. Notice the date. They purchased this on March 31st. That's a key. It has a salvage value of $580 and useful life of 4 years. So remember, June 30th, that's our end time period. That's where we're stopping because we're going to do financial statements on June 30th. We bought, I don't know why my style is kind of doing weird stuff today. I mean, maybe it's just a Monday. Let me start over again. So we've got essentially, let me go back to the dates here. This is March 31st, but you could also simply say that's essentially the same as April 1st. I'll just simplify it. That's the same as April 1st. One day is not going to matter. So essentially April 1st through June 30th is going to be our adjustment time period. So of course, that's going to be, I believe that's 3 months, just to kind of put that out there. So we're going to have 3 months of depreciation. So our calculation will be, I'll write it up here at the top. We've got 11,380, which is our cost. Subtract out salvage value, which in this case was 580. That's our numerator. And then divide by our useful life. Now, however you want to do it, this one says 4 years. We know 4 years is 48 months. So if I divided this by 48 months, that would convert my depreciation per month. And then at that point, just multiply that by 3 if you did it that way. And I came up with right at $675. Okay, that's not the only way to do it, but I think just to be consistent, and just because we're just trying to teach the concept of time periods, I think we always use months. But I think you all would recognize that, you know, you could buy equipment on any day of the year. It doesn't always, it's not always going to be at the beginning of a month. You could buy it on April 17th. And you would have to prorate it per day, not by month, because, you know, that's a little bit more accurate. But that's really not the point. The point is as long as you can understand time periods, that's the concept of accrual accounting. That's all we're trying to teach. So that's why we use typically like the beginning of a month, just to kind of keep it simple. So if I now go back and look at the entry, again, this is for the depreciation. Notice there's your 675 being debited to depreciation expense. Here's your credit of accumulated depreciation then being credited right there. All right, now of course, that's review. And I think I said this last week, but I'll say it again. The difference that the authors try to do in this chapter and chapter 5 with depreciation was, if you go back and review it, most of the problems in chapter 5 had 0 salvage value. All right. In this chapter, just about all the problems are going to give you some sort of amount, 580 or whatever. And I think I actually showed you at least one of them with salvage value, but that's been a few months ago. But either way, just know that we're using the straight line method. Okay, so that's letter E. All right. All right, letter F. Let's do letter F. Letter F says employees have earned $330, but have not been paid at June 30th. So what this one's going to be called, that's an accrued expense. That means that we owe $330. Okay, so we have to book an entry, and this one's an easy one, so I'll just bring this up. That entry would look just like this. Notice they debit wages expense for $330, and then they credit wages payable for $330. Okay. Now, since I'm talking about this, I'll just kind of go over one more thing. I know I did it last week, but I'll do it again. It's called a payroll accrual, and I remember telling you specifically this was right before spring break when all this craziness went down. I think that was a handout or something back in 5. If we had come back from spring break, I would have went over, of course, the accrual entry on payroll, which is what this one is. And the way I would have illustrated in class, and I'll do this right now because I think this will help you with your project, is let's assume we've got a 5-day work week. And keeping the numbers simple, let's say that our weekly payroll is $5,000 that's paid every Friday. All right. So if I did a timeline here, we got Monday, Tuesday, Wednesday, Thursday, Friday. Friday's payday. Let's say on Tuesday, let's say Tuesday was June 30th. And keep in mind, I'm showing you an example here that's not relevant. I'm not using the same numbers in this problem. I don't want to confuse anybody. I just want to talk about the concept of an accrual. The way you would have to do this one is if we had payroll 5,000 weekly, and if our cutoff period is like a Tuesday, that means that technically we have 1-2 days of that week that we owe money, even though they don't get paid until Friday. So if this was, let's say, 2019, June 30th, and then of course we've got July, let's say July 1st starts right there. That's still, again, the same year. But in this case, we got to figure out the cutoff period from June and July. We want to make sure that the payroll that belongs in June goes into June's records, and the payroll that belongs into July goes into July's records. And sometimes you've got these cutoffs where you don't always have a payday right at the end of a period. So we would take that 5,000, divide by 5, we would get simply a daily payroll, which of course is $1,000 per day. So the question is well, how much payroll would we technically owe from Monday and Tuesday? It would be 1,000 times 2, or you'd say $2,000. The other 3,000 for Wednesday, Thursday, and Friday, we're going to still pay everything on Friday, but the other 3 days would technically be recorded for the month of July, not for the month of June. So you have to do this cutoff. This is going to be an accrual. We would still do wages expense, something like that, and or wages payable, and then you would do 2,000 debit and 2,000 credit. Okay. So the reason I'm showing you this, because I believe when you get to the project, you'll have to do one on the project. Well, I just won't give you the amount. This was an easy one because they said we owed $330. Okay, this is an easy one. But when you get to the project, you may have an amount of payroll that you might have to allocate based on how many days were unpaid, whether it's 2 days or 3 days or 4 days. And this is the method on how you would solve that. And I believe the assumptions that I give you, I just keep it simple. I keep everything on a 5-day work week. So you would simply just divide the payroll by 5, and then you'd have to figure out how many days, whether it's 1, 2, 3, or 4, that you'd have to multiply to get your payroll accrual. Okay. All right. So I know I added something to this, but I wanted to try to help you because I don't know if you've even started the project yet, but there is a problem on the project where you will have to do a payroll accrual, and it'll look something like, you want to follow this format on the right here that I've just written out. That's how you do your calculation. You'll still have the same debit and credit entries. It's just that how you have to do it is a little bit different, because remember, in this problem, they just went ahead and gave you the amount. They just said that, oh, 330, they haven't been paid, so basically record the entry. And again, keep in mind, this is all about matching principle, matching expenses in the time period that they were incurred. That's the tricky part about accounting, because you have to watch the dates a lot. Okay. All right. So that was what, letter F. Now I'm going to skip down to letter H. Remember, I think I told you I'm not going to have you guys worry about accruing any sort of taxes. Not that you couldn't do it, but just since we didn't do the one on payroll, don't have to worry about the payroll accrual just on the tax part. So I'm going to be on letter H. This is going to be your bad debts adjustment. So on this one, I'm just looking at my time. I got about 8 minutes. So we got management estimates uncollectible accounts expense at 1% of sales. That would be most likely based on, some sort of past historical amount, past history. So if their credit sales are $2.8 million, all you have to do is take that $2.8 million and then multiply that by 1%. Okay, which I believe that gives you right at $28,000. That would be your estimated bad debts. In other words, this 2.8 million right there, that is currently what is in accounts receivable, from those sales. And if you're wondering about this, the answer is yes. We are estimating that we're going to lose $28,000. We're going to say $28,000 from these particular customers, for whatever reason, will not pay us. That's part of the risk, right? There's always risk. And so to book that entry, and let me just jump, I'm not going to write the whole thing out, but here's the account names they use. Notice they use uncollectible accounts expense, and then they use allowance for doubtful accounts. And of course, here's the 28,000 debit and credit. Just out of habit, I always say bad debts expense, bad debt allowance for bad debts. It's just, again, that's just preference. Doesn't matter. It's the same effect. But again, the new thing about this entry, it's this account right here. This allowance account is a contra asset, just like accumulated depreciation. And I got this answer up, so let me pull this up. Go back, the accumulated depreciation back up on letter E right there. That's also a contra asset. They work the same way. And so on this particular one thing I want to show you about this. So of course, here's your entry. What you do it, here's your entry. So debit the 28,000, credit 20,000, debit your uncollectible accounts expense and credit allowance for doubtful accounts. But just one more thing I want to mention is, if you are on your balance sheet, how this would show up, remember in your asset section, you would have, and I'll just use the numbers from this problem, you would have accounts receivable of 2,800,000 less this allowance of 28,000. Okay. So yes, you'd have accounts receivable of 2.8 million and the allowance account of, what we say, 28,000. So what would happen is you would subtract that. So 2 minus the 28, that's right at 2,772,000. Now, what that means is this. That essentially sometimes is referred to as your net receivable. So in other words, if an investor or a creditor, like a bank, was looking at your balance sheet and they looked at your accounts receivable, what they would see is what they're mostly interested in is not just the 2.8 million, but they're interested in what you actually expect to collect. That's a much more conservative number, more realistic, is that we're not going to get the whole 2.8 million, but we're only going to get about 2,772,000. And why that's important is for a lot of reasons, but we'll get into chapter 13 next week. And in chapter 13, we'll look at what they call financial accounting ratios, where we look at accounts receivables and we do some analysis. And this tells us the liquidity of the company and there's some other measures we look at. But this affects the performance of a company. This could affect maybe a company not getting a stock sale or not getting a loan if they don't have a good turnover of their accounts receivable, or if they feel like they're not collecting their accounts receivable, an investor or a creditor may look at them as being too risky. Okay, so this is a requirement from GAAP. This thing right here, this allowance account is required, generally accepted accounting principles. We've got to book it. And it's part of the risk. Now, keep in mind, this 28,000 is just an estimate. All right. It doesn't mean that's what's going to actually happen. In fact, in reality, the actual amount that you lose will probably be either more or less than amount. You're not going to be exactly 28,000. Okay. But the FASB says you've got to put this in your books. You got to do it. And if you don't do it and then you get audited, you could get written up, you could get a bad audit opinion, you could be penalized, you could be fined. This could affect your company, and you don't want that to happen. All right. Okay. So that would take care of that one. All right, man, I'm almost at 2 minutes. Dang it. Okay, we're almost out of time. So one more thing. I didn't know if I'd get through all this today or not, but so, that was another new one. Letters I and J, guys, those are review. Prepaid rent, supplies, those are good to practice review. I got a couple minutes, so I just want to do one more real quick, and that would be letter K. Just real quick on this one. This is your interest. It says the company borrowed $8,200 from First Bank on, notice the date, June 1st. And remember, our time period here ends on June 30th. It's a 4-month note. Note bears interest at 6%. So remember, this is going to be our PRT calculation. Principal is 8,200 times the interest rate, which is 0.06. And remember from last week, I always divide that by 12 to convert that to per month. And of course, in this case, it was issued on June 1st. So then you would then multiply that by one month. And of course, that would give you right around, I believe it's right around $41 of interest. And then to kind of wrap that up, look at the entry. Oh, let me get to the next page. There we go. It's right there at the bottom. There we are. There's debit interest expense. there's the 41, and then of course interest payable, credit that for 41. Okay, now I can spend some more time on this one on Thursday. If you guys want to come back on Thursday, I'll do another one. But I was trying to do some more repetition on some of these adjusting entries. I'll do another problem with you or two, and if there's anything else you want me to take a look at, just please let me know. Anything that you come across. But just right at that 50 minutes, and I try to give you the same amount of class time. But everything I've done right now is recorded today, last 50 minutes, and once I get it converted over, it takes maybe half an hour to convert. I'll post this whole demonstration today on Blackboard, so you can always go back and review it. But I do hope that the closing entries will help for you. And just kind of watch our time right now, because today is what, the 27th? Is that right? Today's the 27th, I believe. Or
Yeah.
27. Yeah, today's the 27th. Wow. Friday's May 1st. So our timeline is like this. We've got this week we're going to wrap up chapter 12. I'll do some more adjusting entries with you on Thursday. And just speak up. If you want me to do another closing entry, that's fine. This week is finishing chapter 12. The quiz is in Blackboard, due by Sunday. Next week is going to be chapter 13, which is financial statements. And I simplify that a little bit more than what the textbook does. So I got some stuff I'll give you next week. So next week's chapter 13. And then the week after, that's it. That's the final exam week. We're basically at the point. It's crazy how fast it is. So just trying to give you a heads up, and then keep working hard, and don't forget to get that project. And if you get stuck on something with the project, you can just personally email me. Just email my email account, and I can work with you individually if you have some problems, or even if you just want me to take a quick look at it. If you want to see if you're on the right track, just let me know. Okay, guys.
All right. Thank you.
All right, we'll sign out now, and have a good day. And we'll come back again on, I guess, on Wednesday. All right, guys?
Thank you.
All right, thanks, guys. See you.